Britain's economic recovery is showing signs that it can reach self-sustaining momentum, but monetary policy will need to remain exceptionally loose for some time to come. That's according to BOE Governor Mark Carney, but joining me down the line to share his insights is Berenberg Bank's Rob Wood. Rob, Carney also said Britain's economy needs sustained low interest rates to spur growth and repair the stricken banking sector. This statement forms a strong rebuttal of critics calling for a rapid rate hike in response to a galloping housing market. So what is your take on this?
Well, the UK is a long way from normal. It has had a very, very weak recovery so far, and there's tons and tons of figures I can use to justify that, but just to pick one of them, unemployment is a good one to start with. There are about 1 million more unemployed people now in the UK than there were before the crisis. There are a lot of underemployed people as well. So the UK is a long way from normal, and it will need low interest rates for a long time to come. I expect interest rates to remain at rock bottom levels for at least the next 18 months.
Housing does seem to be the big issue in the UK. Prices have been consistently outpacing wages in Britain in recent years, squeezing household budgets and making the cost of living a key political battleground ahead of a general election in 2015. Carney acknowledged concerns about potential developments in the housing market, but recently put the brakes on a scheme to help boost mortgage lending. So if not rates, what tools does he have at his disposal should a bubble start to emerge?
The housing market is a big risk at the minute. The UK is, I think, to take the big picture, at serious risk of a rerun of unbalanced growth and a return to the boom and bust that we had before the crisis. Now, Mark Carney might not use interest rates as the first line of defence against that, and I think that's what his speech last night said, which is, he's going to try and use the more surgical, what they call macroprudential policy measures first to try and tighten mortgage conditions and take the heat out of the market. So I think that's where it'll go first. I don't think housing will cause an interest rate rise, and I think the UK is looking at low interest rates for at least the next year and a half.
Today we have production data which increased according to expectations, but at a slower pace than September. We have NIESR GDP, which should give the clearest indication on this growth momentum Carney is talking about. Some analysts are hoping the string of good data, including a fall in unemployment, should spur an end to QE. But could such a move be premature at present?
Well, I think an important point to keep in mind is the Bank of England hasn't engaged in any QE for well over a year now. It hasn't bought any bonds at all since last autumn. So I'd be very, very surprised if they sanction further bond buying anytime soon or at all. And equally, I think a wind down of the stock of bonds at the minute is also very, very unlikely anytime soon. So the Bank of England is first going to raise interest rates when necessary and then start winding down bond buying afterwards. And I think any move on quantitative easing is very unlikely before 2017 at the earliest.
Latterly, much of the aforementioned positive data from the UK has been having little impact on the sterling, suggesting the good news has already been priced in. With this in mind, and with the Fed indicating Christmas taper is not unthinkable, how are you expecting the pound-dollar to trade approaching year-end?
Well, I think I challenge you a bit on whether positive data are being reflected in sterling. I mean, against the dollar, it's up from around 160 this time a month ago now to 164. The effective exchange rate index, so weighted by trade weights, is up nearly 2% in the last 3 months. So I think positive data are feeding through into sterling over the past few months. But I think where you've hit the nail on the head is that sterling has already gone up very significantly since the summer, and we've had a little bit more, as I say, in the past month. So I think the risks are to the downside on sterling here, particularly once the Fed gets around to tapering.
And Rob, are we going to see the beginning of the end of bond buying in the US before 2014, or is the in-house view still looking towards March?
Well, our forecast is March. I think if we've learned one thing from the Fed's actions over the past year, it's that it's going to be cautious about removing stimulus and wants to really nurse the economy back to health. With inflation remaining very low, they have a lot of room for manoeuvre. So they may taper in December. There is a risk, but our expectation is that they will wait till March.
Well, viewers, that's all from myself and Rob, but click back to Dukascopy TV for our daily programmes, including Press Review and Commodities Corner, focusing on oil. Goodbye for now.